Welcome to Gold Silver Pros.
Hey everybody, this is your host Rob Kientz with www.goldsilverpros.com. I'm going to be doing an update to the silver presentation I did a few months ago where we talked about potential breakout scenarios. We've added in gold as well, and this was contributed from one of my subscribers who has been doing Elliott wave analysis dating back to the 90s, has a lot of experience in it. So this is not my research. However, I have walked through this research and I find it fascinating, so I'm going to present it to you. For that reason, I did want to put in a couple of disclaimers here before we get started. First, we do not offer financial or legal advice. Don't trade on this. This presentation is not meant for trading. It's meant for education and research. Any dates in here are supposed dates on pattern analysis, which I'll talk to you about here in just a moment. This is not for you to take a trade on gold or silver. In fact, before we get into the presentation, I will say a lot of people specifically in silver have gotten in since silver squeeze 3 years ago, thinking that there was going to be a big short-term trade. They were going to make a lot of money in silver. And what I have always said is I do think that the market's going to break to the upside, but it's going to take time. This is not a trader's market. It's a long-term hold market. So if you're interested in the precious metals, they're always, 100% of the time, long-term markets, specifically gold because it tracks inflation. And then I think we may have a breakout on top of inflation, given what's going on in the world. And then in silver, it range trades a lot because now in the modern world is treated as a commodity, and you don't necessarily get that bump of people using it as money. They often say that silver is the poor man's gold from a monetary perspective. We haven't gotten that pop yet. A lot of it has to do with my analysis of the derivative markets, but a lot of it has to do with human behavior. So we're going to be addressing the human behavior aspect of the precious metals equation today. I'm be showing you some charts. They will have dates on them. However, I wanted to emphasize that charting is the result of human behavior. It does not drive human behavior. A lot of people look at charting and say, based on charting, this is going to happen next. I've looked at it and said, based on charting, this is what could happen next if the pattern holds. Particularly when you're looking at fractals or Elliott wave analysis or some of these really advanced techniques, they're there to track human behavior. If you think back to Stephen Hochberg's video that we did a couple of weeks ago, he of Elliott Wave International, he and his partners know, and he said on the program that Elliott wave analysis is not perfect, meaning sometimes the patterns don't fulfill, but the patterns themselves are measures of the past human behavior. So a lot of times we can take them to model what we think may be happening. But just because you see a chart formation setting up doesn't mean it's going to end the way that you think it does, because the chart is a result of human action. So human action comes first, charting comes second. So don't look at this charting as a predictor of a specific date, time, or price. Look at this charting as an indicator of the human behavior that has led us up to this point. And if that human behavior continues in the same pattern, this is what we would expect to happen to the metals. And I want to make this distinction very clearly. I've received a lot of negative feedback, specifically based on silver. I've actually received threats to my business because people are angry that silver has not done its moonshot or whatever everybody's been talking about the last 3 years. And I have to emphasize the fact that, one, markets can stay irrational longer, you can stay solvent, but really what it is, that's not even the real truth. The real truth is patterns happen in investing in human behavior. They mature and they come to fruition when they mature and come to fruition. And all that you can do is follow that pattern as a probability of what may happen in the future, not as a guarantee. So if you're out there investing in silver and you're a very short-term investor or a trader, and you're looking for confirmation silver is going to go to the moon and it's going to do a Bitcoin or whatever, that's not what my program has ever been about or will it be about. And specifically, this analysis is just looking at what could happen if the pattern fulfills. Big disclaimer there, but I felt like I needed to put that out because when I talk silver specifically, even more than gold, people get angry if I say silver price should be going up based on this, and it doesn't. Because what should happen and what happens sometimes, it takes time for all of that to work through the system. And again, silver and gold are always long-term investments. If you're day trading silver, you're going to lose money. If you're day trading gold, you're probably going to lose money. Most people that day trade any market lose money, but specifically gold and silver, because they have been money, and for them to be recognized as money again and to get that true value that we all want takes time, a lot of it. okay? Because what has to happen is the rest of the markets have to go through their problems. You have to have the economics, the fundamentals line up. Then you have to have the recognition by the market, and then the pattern ensues, all right? Big disclaimer, had to have it. Now that we've done that, let's go look at what silver and gold may do. And thank you to the subscriber that provided this. I had a really long chat with him yesterday for about an hour. He doesn't want his name out there, but we did go step by step, chart by chart through the analysis. I'm very familiar with it. I understand it. I'm going to explain it the best way that I can to you guys. And I'm going to tell you what could possibly happen if the chart formations fulfill the current pattern that they're on. If the patterns fulfill the formations. Now, based upon fundamentals, we think that they will. However, I want you to ignore dates and look at the pattern. The key to this is understanding the mathematics behind the patterning and what is likely to happen, not that silver may reach $26.53 on March 15th. That's irrelevant, okay? All right, here we go. I'm going to go ahead and put this up on the stage. This is silver technical analysis and actually some gold as well, a chartist perspective. Now, specifically with silver, he's charting 27 years, and we'll get into why 27 years as we go through the presentation. I'll explain why the chartology on where gold is going and silver is going are on different time periods as we go through the presentation, but I'll show you where it looks as though, at least on current market behavior, as shown in the chart, where gold and silver look to be aligning to have a bull market at the same time, should the patterns hold. In other words, if humans continue doing what they're doing, okay, and we don't have a big macro change that would fundamentally change the value proposition for gold and silver, this is probably what should happen, okay? But as they say, only a fool basically counts his chickens before they hatch. Here we go. Here's a little bit of an update. I'm going to read some of this to you. Just, you don't have to read through. It's very wordy, but according to the chartologist, the completion of the last turning point, wave E, is imminent. That would be the fifth wave, and an Elliott wave, sort of that fifth wave is where you're looking for the sort of climax of the pattern, or the result of the pattern, if you will. Unlike a typical 3-point corrective pattern, ABC, this turning point, which we'll show in a minute, is tracing out a 5-point corrective fractal triangle pattern. Those of you that saw my last video on this understand that fractals are a representation of patterns in nature and in history, all the way down from a spiral design on a mollusk, all the way up to the spiral design on a galaxy. Fractals are basically representations of mathematical or natural patterns that occur that occur both in very small context and in very big context. So in other words, they're basically exponential representations of the same thing. So just because gold went from 1100 to 1200 doesn't mean the next move is from 12 to 1300. It means the next move could be from 1200 to 1500. That's a fractal. It's a representation of a pattern that can be bigger than the past pattern or smaller than the past pattern, if that makes sense. But it's a mathematical analog or equivalent, if you will. Okay, he says, since this pattern is contracting, all the lows are higher lows, a mandatory requirement of all contracting patterns. Based on the long-term resistance line and angle of ascent, it's projected to silver is projected to reach approximately $25 by March 12th. Again, ignore the dates. This is just if this pattern holds, but that's what the pattern is showing right now, making the completion of around 23.25 by March 19th, which is a little bit of a pullback. Typical Fibonacci retracements and angle of descent suggest that this low will reach by March 19th. Once this low is established, or maybe one or more quiet days before the market experiences an historic breakout. Okay, this would be this year. The impulse move to the upside will be highly recognizable and serve as the first indication that the market has bottomed and is moving into a full-fledged historic bull run. I'm not going to read any more in that. You can screenshot this and read the rest. It's a little wordy. I'm going to get into the pictures and graphs. And again, we're not predicting a specific date. I'm not telling you to trade this. I don't want you to trade anything. This is just pattern analysis, and we're looking at the fractals and the Elliott waves and determining whether that pattern is going to continue to hold, and we're going to get the move that so far has held strong. So here we're looking at this is from the last presentation I gave you guys a couple of months ago. This is the 2020 symmetrical triangle pattern on a monthly log chart. And it says we are here. This is back on October 30th. This is the previous presentation, the old one. And you could see that we were into wave E. We completed wave D. We're in wave E. And if you look at the two blue lines, the top and the bottom one, they're doing this. and they're coming to a point. When it gets to a point, supposedly sometime this year, potentially as early as March, but no guarantees, that once it gets to a point, the inflection point would then be up. Okay, that's what the old chart said. Let's move to the new chart. This is the new one. This is a symmetrical triangle from June 1997 to March of 2024. That's a 25 plus year, about 27-year chart. This is on a monthly chart. Very busy, but if you look at the green and red sections, what we're seeing is some symmetry from the last time we had a similar setup and where silver rose. And at the end of this, if you're looking at point number 2 here, right sort of over here on the right part of the chart, there is a breakout from the point of E to the upside, similar to what we saw on the left side of this chart where it went from previously from 1997. So if we hold the symmetrical pattern, and if you look at the right little breakout there in the bottom right of this chart, the projected high could be very, very high. And it's going to be not quite a straight move, but a very large and hard move to the upside. If this pattern holds over the last 27 years, silver could be looking to a big breakout, and it could break out somewhere in the 50s before we have some sort of pullback, a correction, and then moving further higher. Further, when I talked to the analyst, he believes that the silver bull market could run into the 2030s, and it could have different waves in and of itself. So it could go to 50 and retrace back a little bit and then go back up, but eventually in the 2030s is when it would eventually end. So this could potentially be a 10 to 12-year bull market in silver if the pattern holds. There's no guarantee it will. We're just saying if the pattern holds. I'm not going to go through every candlestick on the chart, but just know that's basically what the chart is showing. And again, going back to the concept of a fractal is a geometric pattern or a mathematical pattern that occurs in nature. For example, I'll give the same example again. You see a spiral shape in a little tiny mollusk, and you see a spiral shape in a hurricane, and you see a spiral shape in a galaxy. Why does that spiral shape occur, that mathematical formulaic shape occur from really small things, even at the atomic level, all the way up to the universal level? Because it's math, because patterns repeat. And so if you saw a $5 move in silver, but that same pattern set up again later, it could be a $50 pattern in silver, but it's the same pattern. So it's not linear. It's a bit more exponential, if that makes sense. And that's how natural patterns occur in nature. That's how you can have at the atomic level, how cells work and how electrical charges work. And it holds together something as massive as the universe. It's the same concept on a small scale that works equally well on a big scale. Or if you're a graphics artist, think of a vector graphic. A vector graphic has the information in it to where you can print that graphic this big, or you can print it billboard size, and it will still be the exact same graphic, the same color, the same quality, the same sharpness. A vector graphic in a way is kind of like a fractal. You can take the same thing and expand it or shrink it as much as you want, and it looks exactly the same. That's the mathematical concept we're talking about here. All right, moving to the next chart. If you look at gold, the macro gold chart is from 1972 to 2024. Why 1972? Well, in 1971, Nixon took us off the gold standard, and eventually we were able to hold gold as money again. It was not allowed to be held since 1933. So the chart doesn't go back to 1933 on the gold chart because essentially it was a set fixed price. We go to 1972 is where we really track it, because that's when gold became a part, again, of the free market, where you could trade it as a commodity and a safety asset and essentially money. And there's a couple of things that we're looking at here. We're looking at a running wedge pattern. A running wedge pattern is basically a consolidating pattern where you have higher lows consolidating into an upward trend on the highs. So higher lows and higher highs, and it consolidates in. And if it's running, that wedge is running, usually it means it's corrective, and then it breaks out at the end. You'll also notice within this running wedge pattern dating back to 1977, we have a cup and handle pattern, and that goes from about 2011 to about the present day. Cup and handles are what I call sub patterns that are very bullish in and of themselves. And the fact that we have a cup and handle that's fulfilling or ending this running wedge since 1977. So from 1977 to now, we have a running wedge, which is bullish. And then we have a cup and handle at the very end of that. That cup and handle at the very end, that signifies a lot of pent up need and pressure for gold to the upside. So you've got a bullish pattern within a bigger bullish pattern, if that makes any sense. Key takeaways. All price action from 1980 has been corrective. The rise in gold attributed to inflation and loss of purchasing power, as is gold's historic role. Point 2, 1 to 2 years remain to complete the running wedge, according to this analyst. Now, it may not be exactly 1 to 2 years, and the pattern could fall apart and never complete. But if the pattern completes, it looks like it would take from 1 to 2 years, and it would do that. And then that's a 52-year pattern in the making. And once the last two turning points, wave D and wave E here on the chart, are complete, the real bull market in gold will commence. And it's the exact same pattern in silver. Okay, so I want to go and explain that real quick. What the analyst is saying is gold in particular, and silver to a lesser extent, but really gold has served its role of accounting for inflation. So in other words, if you look at what gold will buy you now and what gold will buy you 100 years ago, you get about the same amount of stuff. And if you look at how much gas silver would buy you now versus what it would buy you when it was money in the 60s, it'll get you about the same amount of gas. So if you chart out gold and silver to regular everyday things, it'll basically buy you the same amount of stuff. And along the way, yes, there's been highs and lows, but over time, generally, gold specifically and silver to a lesser extent accounts for inflation. However, what would change this time in the next year to 2 years is as we get to the end of this fiat money system and the fiat money that's pumped up the stock market and the real estate market and the bonds and all of these other markets, when all of that comes crashing down due to the problems with the dollar and our treasury debt, that's where the money would then roll from those sectors into gold. And when it does, that's when gold starts its bubble phase, essentially. That's the last phase of the bull market that I've been talking about for a few years. And that would be like eventually the bubble phase of gold, where there's actually too much value in gold at some point, historically speaking, to the value of other goods. So right now, gold's been tracing the value of other goods pretty steady, but it hasn't had a breakout. This is just capturing inflation. The breakout in gold comes when gold is seen as the safe haven, the asset of last resort, true money, not only in the United States, but in the global banking system. Money rolls off of all these other markets and flows into gold. And then you get gold as an actual asset class, as money as an asset class. And so not only is it going to track inflation at that point, it's going to go way past it. And that's where that big breakout in gold and silver we've been talking about is going to happen. Because remember, the historical pattern typically is gold goes first, silver goes second. And silver will range trade like this, where gold is slowly going up. So silver goes like this, gold goes up. There's a big gap in the gold to silver ratio. Gold's been tracking inflation, silver not as much because it's a commodity. But then when you have a collapse in the rest of the markets, not only does gold track inflation, but all of that extra money that nobody wants in stocks and bonds anymore gets poured into gold, and it goes like this. And then silver catches up, and then silver gets to its true value. That's the pattern. So right now, gold for inflation, silver kind of sitting here, moving up a little, but that gap widens over time. That's why the gold to silver ratio is so high. But when the fiat system collapses and these other markets begin to collapse because of the excess money printing and the unsustainability of our spending, $34 trillion in debt, anyone, and $2.50 of GDP to create, or $2.50 of debt to create $1 GDP, meaning we're only getting 40 cents on the dollar for every dollar we spend back. That system has to collapse in on itself. It can't, it's mathematically impossible for it to go. That's where both gold and silver then do this. And this is what everybody's been talking about since the Great Recession, the point that we're almost at now. And they're disappointed because the last 12 to 13 years, gold and silver haven't had that sort of moonshot. And they're like, when's it going to happen? Well, because it's just been tracking inflation, because people haven't rolled off of stocks and bonds and real estate. We haven't had that treasury debt collapse. We haven't had the dollar being de-dollarized fully. It's going right now. That we've had the lowest level of dollar reserves across the world since 1971, basically in history, since it's been a pure fiat currency. And eventually, when people lose faith in that dollar and all the other asset values collapse that are based upon the dollar, the stocks, bonds, real estate, all that kind of stuff, even business valuations of a running business that's based on cash, when all that comes crashing down from Exter's pyramid, from all these derivatives into gold and silver, that's where you get the moonshot. And that's what the analyst is saying on this chart is likely to happen. Right now, gold's been tracking inflation for the most part, with a few blips up and down on the radar. But when it gets to the point where that system collapses, that wedge pattern completes here in the next year to 2 years, probably, if that does complete and all that collapse happens as we think it will, And the chart's not a guarantee. It's tracking what's going on. It's not a guarantee. It's a predictor. Okay. It's predicting within the next 1 to 2 years that's going to happen. Then you've got that boom, big pop up. So if you have been saving in gold and silver the last 50 years, right now you could buy about the same amount of stuff and, you know, inflation adjusted as you could before. That's not the bull part of the market. That's tracking inflation. The bull part comes after. And then when gold goes, silver catches up. So for those of you that are frustrated in silver and it's a little bit behind, you know, and you've seen some nice action in silver, but it hasn't stayed at 50, it hasn't gone to 100 that everybody wants. That will happen after gold starts its bull move, after it breaks out of just its inflation adjusted patterning and goes into its everything's going to crap, everybody's going to gold patterning. That's that breakout. And that's at the end of this running wedge pattern that you can see. And you can see it in the two lines going like this. That's essentially what's happening. That's a 52-year pattern. Now, the silver pattern goes back much further. He's only done the last 27 years, but it goes back much further because silver's been more freely traded as a commodity longer than gold. Remember, gold had been fixed price to the dollar because we were in the gold standard. We had taken silver out of the money where we're no longer in a bimetallic standard since 64. So that silver pattern is a little bit longer forming, but they're coming together. The patterns for silver, this symmetrical triangle, and the running wedge for gold seem to be coming together at the same time. So in other words, about the time that everything starts to collapse in this fiat system, gold and silver will then align. The gold-silver ratio will shrink together and they'll both just go boom like that. Again, not a guarantee. That's what we've been tracking on the chart. The chart is backward looking to what's already happened. If this pattern fulfills, in other words, all the fundamentals stay the same and all the humans behave the same way we would expect them to behave when all this stuff comes crashing down, then the chart should fulfill. And when it does, boom, then you got your next move. Next slide is the macro silver chart, 1932, 2024. As I said, silver is in a much longer timeline because essentially gold was taken out in the executive order of 1933. Silver was eventually taken out of the money in 64, but silver is still freely traded as a commodity. So the silver chart goes much longer. And if you look at the silver chart, you can see here a nice run up in silver, and then it came back down, but we've got this cup and handle over 40 years, a 40-year bullish cup and handle in silver up here in the top right. He's got it marked as cup and handle pattern. Okay. That cup and handle pattern, what it's doing is as this wedge is coming together all the way back from 1932, this cup and handle pattern is sort of the culmination of the pent up massive demand for silver, not only as a monetary asset, but as an industrial asset. And so that seems to indicate that when that triangle completes, the cup and handle will complete at the same time. And then you're going to have that launch forward. And because silver has a longer cup and handle pattern than gold, the launch forward should be as a higher percentage, allowing that gold silver ratio to shrink to what people want it to be. Okay. That's why people trading silver for gold right now, if you're looking at the chart, that's not really the way to go if you believe that this chart will complete, because a silver will, as a percentage, move more than gold. So you want to be trading gold for silver if that's what you want to do, if you're trading the gold silver ratio. I'm not telling you what to do, but that would seem to be that make the most sense there. So this running wedge pattern in silver, you know, essentially dates back to 1932, but the current running wedge dates back all the way back to 1980. Why 1980? Because that's when silver hit its high in 50 bucks. And when did silver hit its high again? It hit its high in 2011 when it touched on 50 bucks, right? And that's not inflation adjusted. So actually, if silver from an inflation perspective had reached its 1980 price, it would have gone over 100 bucks, like 150, I think is what it was. So, but in any case, that's that wedge pattern since 1980, the last time silver really popped. And that wedge pattern is showing that silver is nearing a breakout. Now, the silver breakout, as you can tell, that wedge pattern is a little bit more open-ended on silver. If you're looking at the top right part of the chart and those two blue lines, it's a little bit more open because I think silver big breakout will come after gold. So we go back to gold. Let me narrate this chart. If you look at that running wedge pattern in gold, up near point E or point 2 on this chart, it's got a little bit of space to where that connects, and then you get the big move. In silver, it's a little bit more wide open. I think because silver takes a little bit more time after gold to do the same thing, and because that silver is we're tracking silver over a longer period of time. And that has to do with when silver was allowed to be money and silver is taken out of money versus gold. So gold has a shorter pattern, silver a bigger one. So silver is going to take longer to come to fruition. So gold's going to go first and silver will come after, if that makes any sense. Okay. Hopefully all of that made sense to you guys. It's very complex talking about this charting and talking about what's going on. So I'm going to summarize for you here, basically, essentially what I said. One, do not trade on this data. We are tracking a pattern that has not fulfilled yet. This is not a 100% predictor. However, if the fundamental things in the economy and the fundamental human behaviors that we've observed throughout history continue as they are continuing, and the fulfillment of the collapse of the dollar system, then we should have the fulfillment of that patterns and gold and silver I just showed you. Okay. It's not a guarantee. What if something changes? What if we go to nuclear war and we're all Mad Max? No one's going to care. We're not going to worry about gold and silver anyway. Or what if the sun explodes and we all evaporate? Or, what if one of these, big things that we don't control happen? What are the possibility of that? Probably slim. So more than likely these patterns will complete, but there's no guarantee. If the pattern's complete, remember what I said about fractals back in October. Fractals are mathematical representations of things that can either expand as much as they want or shrink as much as they want. So just because last time in silver we might have gone from 4 to 50 doesn't mean we're going to go from 4 to 50 this time. We could go from 20 to 600. It's a fractal. The pattern, it doesn't, the amount of change within the pattern doesn't matter. It just matters that the pattern holds, if that makes any sense. Again, go back to why the universe can survive on a grand scale and a universal scale based upon subatomic principles and subatomic concepts, natural concepts, because those natural concepts work at the small level, the medium level, and the big level. They work the same in markets. Because why? Because it's explaining human behavior. What are humans? We're part of nature. What are we talking about? Math is talking about how nature works. So don't worry about the top line price. It doesn't matter. Just let the pattern fulfill, and let it fulfill when it wants to fulfill. It's going to fulfill when it needs to fulfill. When all of the natural occurrences for that pattern fulfill, economic, cultural, political, then that pattern will fulfill, and then you'll see the move. Okay. When that could be, well, it depends. These are long-term charts. Trying to predict a certain day or time or even week is kind of a fool's game, because there are millions of things that go into it, and it just needs to complete when it completes. And even though there are parallels between these patterns, they're not 100% exactly like you can put one on top of the other. There are some, differences along the way that account for differences in how we treat money and culture and politics along the way. However, the pattern looks to be fulfilling. If the pattern fulfills, we'll break out of where gold is just tracking inflation. All this money will come into gold, and then we'll see gold continue to march up. Now, if I look at the central banks, they already know this. The central banks have this research. They're not dumb, okay? Some of the smartest people, mathematicians, chartists, technical analysts in the world work for the central banks and the governments. They know this is coming. That's why I believe since 2010, 2011, the central banks have been buying more gold. They introduced Basel III, which made gold what? An HQLA, or a high quality liquid asset, just like bonds and stocks of other central banks and currency. And that's why they're filling their coffers with gold, because they know that this is going to occur. Right now, gold is trading to inflation. It's increasing to inflation. But when everybody goes into gold, the value of gold will go way up because they're coming out of other assets. That's what's going to capitalize the central bank's balance sheet. So it almost doesn't matter how much dollar crash or currency crash you have in treasuries if you have a bunch of gold. That's why the central banks are doing it. They know based upon this charting, the fractal concept, the Elliott wave concept, that gold's going to go up a multiple of times of what its price is now. And it's going to help account for the losses that they're going to have in these other assets. That's why they're buying it. Gold is the only thing right now, and silver to a lesser extent, that's going to be able to account for all the losses in this fiat system that were caused by all these blown bubbles, by all of this excess paper. And that's why price in itself doesn't matter, because price is just a measure of how much inflation you have. It's not price that matters. It's the pent-up demand and how it's used and what the pattern is showing you. And that's why I want to bring this pattern analysis to you guys. We think that it could start sometime this year. Now, if you go back to what Stephen 𝘎𝙁 said, Stephen 𝘎𝙁 said on my program a couple of weeks ago, when we're talking about the stock market, for example, he thought it was going to reach a grand cycle maximum in early summer, I believe is what he said, sometime this summer. And if it does, that means the flows are going to start going into gold out of stocks, and into gold out of bonds, and into gold out of these other things. And that would be when you start to see the real moves in gold and silver start to happen. These patterns in gold and silver can go for years. If you look at the Great Recession, it basically went from 2009 to 2011. Actually, gold and silver had started to rise before that, as you know, the smart people in society, the money people in society were vested in it. But the big moves were about over 2 to 3 years. So analogous to that, if we take that fractal concept and kind of paste it onto what we have now, the initial moves in gold and silver will be big, but they'll be muted until the rest of the world knows, going beyond the central banks and the well-heeled, and everybody knows. And then you'll have the really big moves in gold and silver. So it'll start going up, and then boom, you'll have your big long run. But that long run actually may be longer now than it was last time. Why? Because last time we had the Great Recession, but we papered it over. And because we created so much new currency, it set the stage for the pattern we're going to see now, but it didn't complete the pattern back in 2011. We staved off that pattern with the excess money creation. But that excess money creation is going to create the pattern even bigger this time than we had last time, I think, based upon the fundamentals. And that's also what the charting shows. And again, last disclaimer, please do not trade off of this research. I'm not a financial advisor. I'm not telling you what to do. You have to do your own research. You have to contact your financial advisor, your accountant, your lawyer, whatever, whoever. I'm just saying this is pattern analysis. If the pattern holds, and these are multi-decade patterns, and human behavior continues as we've expected human behavior to work, and natural law about money holds, which it should, you know, sans us going into some weird, you know, fourth dimensional plane where everything's different. If everything holds as we know, those patterns should complete and we should have those moves. It's not a guarantee, but that's what we think is going to happen. Hopefully I've explained this in a layman's way that you guys can understand. It's very complex math. I don't, you know, I'm not a full-time Elliott wave analyst, but I understand the concepts. But what I really understand is I understand how the fundamentals eventually line up with the technical side, or the numbers. The fundamentals of life manifest into mathematical patterns that you can see on a chart. A chart is a mathematical pattern. Think back to geometry, trigonometry, calculus, and algebra. What are you doing? With all of those mathematical disciplines, you're basically using math to draw what? A picture about what? Whatever. Population growth, business sustainability, whatever you want. That's what we're doing here. We're using the fundamentals of what goes on in life, the natural monetary law, natural human behavior, and natural universal law, and we're applying it in this case to the monetary system and charting out what we think can happen. No guarantees, but it looks like that's probably where we're going to go if everything holds serve the way that we think that it will. So if that's the case, it's good news for gold and silver investors. But again, watch the charts, watch the pattern. We'll come back and revisit this from time to time and see what's going on. But this could be a really good indicator of a rough timeline, not an exact, but a rough timeline, relatively speaking. And remember, the universe is millions of years old. So relative can mean wide time frames, but we're talking relatively speaking, what we think is going to happen and about when. Okay. So just track that, track those patterns. If they continue to hold, that's good news for gold and silver investors, not necessarily for everybody else, because what it means for everybody else is wealth destruction. Whereas for gold and silver investors, it would be what? Wealth creation, not just keeping up with inflation since 1971 that gold has, but actually creating wealth, because all of that value that's being dumped out of those dollar-based cratering assets as the dollar comes crumbling down and we move into the next system, moves over to what? Natural money. Why? Because natural law says people will gravitate to what has real value. As people realize the existing system doesn't have real value, they'll go to real value. And that's where the gold and silver is going to get their extra boost beyond inflation up through that last pattern. And that pattern could last a number of years. Now, if we get into that breakout in the next 1 to 2 years, if that does happen, if, then we'll begin charting what that looks like. And does that look like the previous breakouts, or is it going to be bigger? And we'll track it at that period of time. But for right now, we're just tracking, does that wedge close? Do those cup and handles give, you know, at the very end of both of those wedges, gold, silver, give us the impetus we need to break out and go forward like we've all been expecting and thinking would happen for years? We may be getting kind of close to that. The patterns are depicting that. The math seems to be solid there. The only thing that would change it is if something fundamentally changed with our universe and our macro environment, so big that it goes beyond our individual market behaviors, if that makes sense. So it had to be something really big. Space aliens landing, we go into Star Trek world, the sun explode, those types of things that we don't control. But sans one of those types of things, without one of those types of things happening, if natural law is still the same, we're all here, humans are acting the same, we expect the completion probably of those patterns pretty close to what it looks like on the chart. But we'll continue to follow it. And again, don't trade off this advice. Just use it for research, understand it, know what it's depicting, know what it's telling you. And specifically for those of you that are frustrated, pissed off, exasperated, give up in the metals markets, you may be giving up at a time in which we're about to see the move that we've always wanted to have. And we're going to continue to follow that here on this channel. All right. I am off to Toronto tomorrow. Actually Saturday, sorry, in a day or so. I'll see you guys up there. They're going to be in Toronto for PDAC, the big conference at the Toronto Convention Center. PDAC.ca is the website if you want to go see it. I'll be doing the Sunday morning. I'm opening up the Investor Leaders Forum. I think I'm the first presenter Sunday morning at 10:35 after the intro. I'll be there in the morning. I'll be at the conference the rest of the day and also on Monday, and then I'm coming back Tuesday. So until next time, Rob Kientz, www.goldsilverpros.com.